morning, everyone, and welcome to this webinar. My name is Ryk van Niekerk. I'm the editor of Moneyweb. I'm also the presenter of the radio show RSG Geldsaake. And today we will look at the prospects of the local and international markets in 2022. When I wrote the introduction to this webinar earlier this year, it seemed as if 2022 is going to be a bumper year. We saw a solid performance in 2021. And the markets ran during the last, few months of last year, and it actually continued that momentum into this year. Many markets around the world hit new record highs. It was fun times for all investors and especially fund managers. But over the past, few weeks, these markets have lost a bit of steam. The JSE is down around 4.2% from recent highs. The S&P 500 is down 7.6%. The Dow down 5.6%, and the Russell 2000, an interesting index. It represents about 2,000 small and mid-cap stocks in the US, has dropped by more than 20%. So a significant pullback there. And hopefully we can make sense of this today. We have got a very experienced panel of investment experts to help us. I would also like to hear from listeners to this webinar. Please post questions in the text box, and I will put it to the panel. And I'm sure we're going to get some really fantastic insight today. Delphine, I want to start with you. And I just want to, and I'm going to ask the same question to all the panelists. Just exactly what are your thoughts of what happened last year? And what do you expect for this year? And what do you think the main drivers of markets will be in 2022?
Thanks, Ryk, and morning, everyone. 2021 was a fantastic year for equity returns, obviously in the South African market. But I guess it needs to be put in the context that it was a rebound year. It was a recovery year. Not surprising, I think it was the best year since 2009, which was another post-crisis year. So that context is important, is that it's a recovery through a post-crisis period, and we all know the reality, perhaps. What was interesting for me in 2021 was that it was really about, as much as we could say certain sectors did well, it was actually, headliner stocks within those certain sectors rather than a broad-based recovery. But if you look, and I'll talk about that in a bit more detail, but if you look at just markets generally, the all-share index, which is a kind of the long-standing benchmark index that everybody has historically looked at, did over 29%, but something like the SWIX, which is the more recent index over the last decade or two that folks have looked at, only did 21%. And the stark difference there was just weightings of individual stocks, which contributed to quite differential returns. And perhaps the most standout feature of 2021 was that after many, many, many years, Naspers and Prosus actually were among the worst performing shares. So I think the second and third worst performing shares, both ending the year close to 20% lower. So that was a highly unusual year. So something to have borne in mind. But what was interesting, I mentioned from it being a stock year rather than a sector year, that you could say, energy had a strong year, consumer discretionary had a strong year, telecoms had a strong year, and healthcare. But really it was, Sasol, Richemont, MTN, and Aspen. It was 4 stocks if you look at the top 10, and then a handful of small caps. So the other, I think, interesting feature for me in 2021 was that the small cap index did way better than large and mid caps. And again, it was very stock specific, stocks like RB Platinum, Soho, PPC, really recovery ideas, rising in excess of 100%. So firstly, to put that in context, that it was an unusual year in terms of the quantum of equity returns, particularly for the sector as a whole, if you look at domestic equities, but then what drove it, which was quite unique in terms of stock specific points. And then as we move into 2022, I think obviously the base is important. So be pretty hard, I would say, for domestic equities to repeat another 20+% year. But notwithstanding that, again, my sense is that it remains a stock picking year, as opposed to a year that is about, sectors doing well. And within the stock picking, I think you can pick up a couple of themes. So, before I hand over to some of my colleagues, I think some of the themes that we're seeing are that there were some sectors that I would call late stage recovery. They didn't enjoy the recovery in 2020 and 2021. And a good example would be hospitals. So those are stocks that are in our portfolio. So the hospital sector, the likes of Life Healthcare, Netcare as an example. And then you also see some of the kind of inexpensive companies or sectors and stocks within those sectors which are not exciting, but actually are very, very attractively priced. And here I would put the South African banks. So we're moving into a very interesting period where economic growth, from a macro perspective, is not going to be exciting. So you're really looking for businesses that have something that they can deliver for you that is not necessarily a leverage play on the economy. But I'm sure as we circle back, I can talk you through some of our ideas.
Okay. Chepo, your thoughts?
I'd echo a lot of the sentiments that Delphine's, but I think from a big picture perspective, the big drivers going forward, I think we've seen stellar returns, and yeah, I think I'd characterize 2021 as a recovery year as well. Whether you're talking at a broader global economies or indeed underlying companies and the stock markets. I think going forward, we've seen, as you touched on, quite a bit of volatility, and that trend is likely to continue. I think the big themes going forward will be what realized inflation does in comparison to market expectations around that. I think that will be a key theme in driving a lot of the returns, certainly in the offshore markets, probably likely to see a divergence in terms of fiscal and monetary policy between, as an example, the US and China. So China is will likely be in an easing phase in comparison to the US tightening, and that will have a major effect on stock market returns across emerging markets versus developed markets, and that will filter through into the JSE. So I think whilst 2021 was a recovery year, I think a continuation of stock picking again this year, but a lot more broader market volatility is likely to continue.
Carl?
I mean, quite a lot has been said already. I mean, I think the major messages I'd be giving is I think that the sell-off we've seen in global markets is a very positive development. I don't think people should look at it with too much anxiety. I think the market was very frothy. There was a lot of discipline being lost. And I think that this correction presents a lot of opportunity to stock pickers, because I mean there've been very dramatic declines in parts of the market that don't look anything like the sort of 6 or 7% that you've seen for the S&P. So I think it presents opportunity, and I think it's just healthy, because I think that kind of sort of speculative froth that we were seeing in markets in the back end of last year is quite dangerous. And I think that there's a lot that people are worried about. People are worried about inflation. People are worried about geopolitics. People are worried about valuations. And I think that that's good. When no one around you is worried is when you really need to be nervous. And when there's a lot of anxiety and concern, typically there's something priced in the markets for you. So even, back end of last year, we were very bullish SA, worried about global equities. As of today, sitting here, I'm actually fairly optimistic about what a stock picker can do in global markets. So, we're now sitting pretty optimistic. Domestic assets and global equities, with only really global bonds has been the asset class we're negative on. So all in, from me, the message is, notwithstanding a really good year for the SA savings industry in the last 2 years, we're optimistic, and we think there's lots of opportunity. And if you look at the flows in the SA savings industry, a lot of money sitting in SA cash, and I think that's a big mistake.
You referred earlier to a loss of discipline. Can you maybe expand a bit on that comment?
Yeah, I just think you've had a generation of investors in global markets. The investors who've done well over the last 10 years are those who have been on the right side of so many businesses that either didn't exist or were really small a decade ago and have become the world's big companies, prospered as the world has transitioned into a digital economy. And a lot of those investors are not very disciplined in terms of price, spend very little time trying to work out what businesses are worth. And, they ask themselves what the winning businesses are and invest there. Some of them will, make a stronger argument to saying we don't spend much time in the financials, we don't spend much time in models, we just try and understand businesses. And I think that pointed to me to a loss of discipline. And that's just the pendulum swinging. 15 years ago, the value investors were preeminent in markets, and they were incredibly disciplined, spent hours poring over financial statements and valuing businesses. And a decade later, they're forgotten about, and it's the sort of growthy quality managers, and I think that went to very unhealthy extremes. And I think a little bit of rebalancing in markets is positive and healthy and good for all of us.
Interesting. Shlelo, what are your thoughts about the prospects for 2022?
Sure. We tend to look at things in swaths of 5 to 10 years. And I think in the last 5 to 10 years, you can comfortably say that investors enjoyed consequence-free returns. The subsequent period from today onwards, I guess this year onwards, returns are not going to be as great as they have been in the past 5 to 10 years. And I say that because from 1907, 1908, when the Fed was launched, to today, 40% of all the money printed in the U.S. was printed in the last 14 months. The last 14 months. Think about that. 40% of all the money printed since 1907 to today was printed in the last 14 months. The Fed has just done a great job of making our jobs easy, you can call it, if you're on the right side of it, as Carl says, as portfolio managers, because the Fed underwrote risk. So valuation models really disconnected from fundamentals. And that's what the Fed really wanted to do, to get inflation to be where it is today, to get GDP growth to where it is today, to get unemployment to be where it is today. And the Fed is not having to play catch up to reverse all of that. So you have to ask yourself, where did all the money go? Where did the $40 trillion of ECB money, Japanese central bank money, Fed money go? And it went into some companies who didn't deserve or couldn't afford to have the creditworthiness to get funding in the capital markets, nor in the bond markets, okay? So if you were fighting against the Fed, and we've been guilty of that, we've been fighting against the Fed saying this is not the right monetary environment to conduct. If you've been fighting against the Fed, you've done a terrible, terrible job. But if you stay focused on companies that are cash flow generative, low volatility to how they make money, low cyclicality to their products and services and to their revenues, highly cash flow generative, I think you will be just fine. I think the prospects going forward are really bright for not only cash flow generating businesses, but high dividend yielding businesses. And you can start to see what's turning in the market as high dividend yield businesses are outperforming low dividend yield but high growth businesses.
Very interesting comments there. Delphine, I just want to add to that, there's a lot of liquidity in the market. It will be eased in the coming months. We're also seeing the US entering a rising interest rate cycle, as have many other countries around the world, including South Africa. Do you think that will fundamentally change the investment outlook? Can you maybe just comment on how it may impact the US market or international markets, and then as well as the local market?
Sure. So, Rick, I think the backdrop that you just painted, and my colleagues just before as well, really speaks, particularly if you look at all the factors that are contributing at this particular, we could call it an inflection point because it feels like an inflection point, is almost uncharted territory, and that's not trying to be overly dramatic. That's just a fact of the fact that we're coming off the lowest interest rates, the lowest interest rate regime ever. That we are now, all those factors that you alluded to are now in the recipe, in the mix. But at the same time, I'm cautious. If anything, the observations that have been shared so far this morning have been saying that while we are in an environment where some of the ingredients create this almost uncharted mix because of where we've been, but particularly where we've been, for the last 13 or 14 years, not where we've ever been. I guess the challenge, and I think as Carl alluded to, is that many people that are market participants have actually only been participating in the market in the last 10 to 13 years, as opposed to in some of the previous cycles. And they don't actually have much of the history or the understanding of how some of these previous cycles have worked, particularly when they get to this overheating stage. And so as we look ahead, I think what we're starting to see is the separation from, particularly one of the worst performing kind of cohort of companies in the last month to date has been loss-making companies, which shouldn't be surprising, but for many quarters and many years over the last decade, because these were the narrative stocks and the story stocks, the numbers didn't seem to matter much. And really, because of how emotions drive share prices in the short term, we tended to find that the narrative was what was being valued and priced. But yet, over the long term, it's both the story of what a business is offering you plus the numbers. You've always had to have both sides of the coin. And perhaps what we're seeing is that we're starting to see a normalization, largely, of a balance between the numbers having to deliver the goods, and not just the story stocks. But so what it does is that we now sets us up, and perhaps that's where the anxiety is in the market at the moment, because we've got perhaps inexperienced participants. Not that they, there's one thing having seen cycles and another thing, having, fantastic intellect. These are not mutually exclusive things. It's just about how you react at this point in time. And the majority of investors that have been around for, longer than 15 or 20 years understand actually that, at this point in time, the trouble or the extreme in sentiment as the pendulum swings actually creates fantastic opportunity. And this is where we're starting to see it, particularly outside of, the US itself. They, 5 stocks, if you just take this S&P 500 and you look at what happened to 495 stocks and look at what happened to 5, very different picture. So but yet we tend to be very drawn to what the headline numbers say or the optics say of what indices print. But underneath, there's fantastic opportunity and fantastic value if you're willing to look out, and particularly because the mispricing tends to occur in the extreme and is connected to where the emotions sit. And whether you're looking outside of the US, so we look in, for example, in European markets, definitely opportunity. Obviously, those are markets that typify what has been, largely old economy stocks, industrial heavy, financial heavy, utility type heavy sectors, not as tech heavy as, for example, the US is. So yeah, we're starting to see, and we in our global portfolios, we've been underweight the US for some time, quite overweight, for example, places like selected European countries, and then also very interesting opportunities coming out of China. China was the one stock market that declined over 20% last year, and as a result brought the emerging markets down. If you excluded China from emerging markets last year, the emerging market index would have risen about 10%. So there, if you, again, taking a multi-year investment horizon, really some good opportunity in structural growth spaces, which are actually making money.
This notion of inexperienced investors, undisciplined investors, I appreciate that, asset management has changed over the past few decades, but it seems like these investors are moving the market more than you would expect from asset managers. Is it a new style of investment? How will that impact the traditional fundamental analysis, focused in investment strategies? Chepa, you are smiling. Do you have any views of how undisciplined investors, I don't know if it's speculators or how you would term them, how do they move the market? Because it seems like they're doing a fairly good job.
I think, well, that's a particularly tricky question, but I think the reality is that there's a fundamental reason why 5 stocks have moved a fair chunk of the S&P 500. Fundamentally, the likes of Microsoft and Apple have operationally done incredibly well. Now, there's been a happy overlap between that fundamental reality and the share price movement. But as always, markets are cyclical, and mean reversion is a particularly powerful force in the market. And what works well for even a decade might not continue working well. I guess the trick with any investment strategy is figuring out where you are in terms of that inflection point. Assessing and trolling through fundamentals and models certainly helps you assess that differential between whether stocks should have gone up or not. So what I guess the underlying point that I'm making is that some of the stocks that have done well over the course of the last 5 years or a decade rightfully have done well because the underlying business reality of those companies has been exactly that. Now, our view is similar to my colleagues, is that the market is broad. Whether you're looking at the US, you're looking at South African markets, or emerging markets as a whole, opportunities lie beyond companies that have historically done well. And that is where having a disciplined investment approach that can help you identify those opportunities kicks in, and it's periods like this in the market that will then I guess differentiate the skilled investors relative to the narratives talking.
Shlelo, Carl, do you want to add something to that? I think that's an interesting topic to discuss.
Sure. You know, share prices reflect oftentimes 10 years worth of free cash flow. All right. And if you think about the uncharted territory Delphine was talking about, it's actually the uncharted territory has been in the period of unadulterated monetary liberalization, monetary policy that has just gone into the market to underwrite risk. And if you break up share prices into cash flow today and growth, growth in cash flow tomorrow, a lot of companies that were promising cash flow tomorrow because of their business strategies, because of disruption perhaps, those are the companies that investors who took money, free money, whether it's cheap money, leveraging it up, or stimulus money from the Fed or from the ECB, or from their fiscal governments, and put that money into equities. They were buying companies that were going to report great cash flows tomorrow. That's those cash flows priced into their 10-year share prices. Okay, and so when the Fed starts to raise rates and you can't leverage up anymore, and in December the Fed is going to start to sell back what it bought from the market in terms of quantitative easing, sell it back into the market to shrink their balance sheet. These are the folks who are going to have to pull money out of companies that are going to report growth and cash flow 5, 6, 7 years out, pull the money out and either pay back the loans they took to leverage up their investments, or simply go bust. And you're seeing a lot of that now in Robinhood type investors who cannot buy the dip anymore. They cannot buy the dip anymore because the Fed just last put in January, I think, $30 billion of expanding their balance sheet. From now on, rates are going up. So the 10-year yield, the 2-year yield starting to go up, even though the yield curve is flattening. But those investors, similar to investors in Bitcoin, are learning a hard lesson that the fact that you're getting money cheaply in an unprecedented and uncharted period over 10 years doesn't make you, with the fact that you're getting that money cheaply and that you're able to identify future growth businesses, doesn't necessarily result in a perennial ability to either outperform the market or create wealth. And so in the market, there'll be losers, and the investors who've done that will lose. companies who didn't deserve to have their bonds bought by the market, junk bonds that are issued by weak companies, they'll lose. There'll be bankruptcies. The unemployment rate, I think, will jump up from 3% to about 5 or 6%. The economy will slow down a bit. There has to be a rebalancing, and it's going to be very hard for the Fed to land this thing softly. It's going to be very hard. There'll be casualties along the way. So if these investors haven't changed anything, they just took advantage of a window that was created by the Fed to underwrite risk. There will be losers in this thing.
Mm. A question from Bilal. He asks, what is the view of the panel regarding growth stocks like Tesla, Apple, Nvidia, Microsoft, stocks that have run really, really hard? There has been a pullback in some of them. As I interpret what you are saying is, listen, be careful of these type of stocks. But Carl, how would you look at some of those high flyers?
Yeah, I think you have to be very careful of broad brushstrokes. Be very careful if someone's saying value shares are where you want to be. You don't want to be in growth, or the converse of that. I think what's happened now is you've seen a rally in some of the very sort of really cheap value stocks that were really neglected in the last 10 years, and I think you've seen a whole lot of the sort of really frothy sort of growth stuff pull back. And I think what's going to be required here is, good thoughtful stock picking, that doesn't approach the thing in a very macro manner. And I'm pretty sure that in the universe of exciting growth companies, there are fantastic opportunities, just as within the universe of value shares, there are fantastic opportunities. And I think the challenge is going to be invested with someone that can identify those. I would be very cautious of saying, only value, not growth, or growth, not value. I think you want to really focus on companies, and I think that in the carnage of the last 6 weeks in growth stocks, there's plenty of opportunities. Similarly, I think there are a whole lot of value shares that were extremely cheap. They've gone up 20 or 30%, but they're still very cheap today. And so I think you've got to approach this thing stock by stock.
Let's just talk about expectations for 2022. There is a lot of uncertainty in the market. There is a lot of noise. I don't know how many actual signals there are to provide a more accurate, indication of what could happen this year. As fund managers, what would you be happy with, a yield locally versus internationally? What would be acceptable? What should investors be looking at, without trying, in the light of having had a 30% rise last year on the local market? What do you think would be a good expectation? Shlelo, let's start with you.
So I think you should look, well, one of the ways you could look at it, now, you can look at it where you want, right? But one of the ways you could look at it is that there are always two drivers to total returns. It's capital gains and dividends, right? And what has driven the majority of returns in the past 5 years has been capital gains, okay? And this is exactly what I was talking about earlier, that, if someone is underwriting risk for you, why not take a shot at future growth? And a lot of investors have done that. Just take a shot at it, and you've gotten capital gains from it. So if you really want to start building an expectation of future returns, start with the dividend yield, because you're buying companies today that are cash flow generative that can fund a dividend, in addition to funding their operational capability and their comparative capability. So you start with a dividend. And if you say, well, today look at banks. Banks are on a dividend yield anywhere between 4 and 7%. So you start with that, right? And you say, well, how much future growth can you put into what a bank can generate over the next 2 years? And if we have a yield curve where the 10 is greater than the 2, they can fund themselves on a 2 and lend out on a 10. They can have an expansion net interest margin, right? And so that, if that's greater than the impairments that will surely come, they'll have a growth in earnings. What kind of growth in earnings? Well, greater than GDP. Now, GDP is not much here, but greater than inflation, right? So they're going to have real earnings. So if you say, how much in real earnings, you can say, well, 7% 8% in real earnings plus 4 or 5%, well, maybe 11% in annual expected returns. That's the sort of exercise you'd have to do company by company. But I think what's going to drive the majority of returns is going to be first start with a high dividend yield from a competitive business. And then you get to what the competitive advantage can produce in terms of earnings growth. So around about the 10, 11% is what you really should expect, being underpinned by dividend yields.
Yeah, Delphine, 10, 11%, that's pretty much the long-term average of the local market.
Yeah, I mean, I can't argue with, Shlelo's maths and reasoning there, because I think that's, that's how we look at the source of returns from equities as an asset class. Obviously, as fundamental and as professional investors, we're now looking for, for companies, when we're plugging in, what we expect those asset class returns to be in a multi-asset class or your typical balanced portfolio. That gives you a sense for how you should perhaps have a relative positioning between, a domestic equity asset class or a global equity asset class or a domestic, fixed income. But then naturally, the actual selection of stocks that you would have, given that we're all active investors, we would expect the underlying stocks to do better than that. So, our pick of domestic equities we would hope now and we look at stocks at Perpetua on longer than a 1 year horizon, so at least a minimum of a 4 year horizon as we look at its kind of expected return, to do better than this. And that's largely just because of where we're hunting, the base effects, where we're the starting point in terms of stocks that perhaps didn't rally as much in the last 2 or 3 years in the post-COVID crisis. And so the point being that you can't always equate or conflate an asset class return with perhaps a particular expectation for a particular portfolio. I mean, we're always cautious. I don't think there's any fund manager that can tell you what their portfolio is going to do on a 1 year basis. It's just because of so many things moving, component parts. But one definitely can give you a sense of expectation on a longer period, and that's largely because of the fundamental components that are driving the sources of return that we're seeing in the underlying stocks. So the point being that I would concur. It's definitely time to moderate one's expectations given the base. But domestic equities, given even if you exclude the whole resources sector, which is currently trading on very attractive optical multiples, but on peak earnings. So even if you just normalize that sector or exclude it, South African stock market is trading on below its long-term PE on a forward basis. But really, that's just meaning that the market is not expensive. You really then have to go to the fundamental component of returns, which, as Shlelo said, is dividends, which obviously is a function of earnings. So it's really earnings and dividends on one hand versus sentiment and price change on the other, which is the multiple. But yeah, I think we're optimistic. So the point being, us as investors, we're a strange bunch, because on one hand, our job is all about the future, and therefore one needs to have an optimism, but most of our time we spend being slightly skeptical and questioning where we could be wrong. One of my former colleagues often said, we get paid to worry. So we're continuously worrying about where one could be wrong about the assumptions that we have that are baked into our portfolio, are baked into where we're placing our bets. But at the same time, and I think it's particularly hard in a domestic macro environment like the one we're investing in, where the macro is actually your headwind, that's not your tailwind. And so you're focusing your energy mainly on businesses where management can deploy strategies that are not necessarily a bet on what the economy can do. It's actually about what they see as an opportunity set, whether it's a restructuring play, a special situation, etc. But yeah, so it's an interesting time. But actually, this is why we're in this job.
I like the fact that you're positive. I'm going to jump into a few questions, and I don't know who to put this to, so please indicate if you want to jump in. Sean asks, if you had an open global mandate, where would the bulk of your exposure be? So geographic question, big local and offshore type of debate. I don't know, Carl, how do you view it?
Yeah, I mean, we became very negative on global equities late last year, and we've been bullish local asset classes for a long time. with the big sell-off that you've seen in the last few weeks, I actually think sort of a balanced portfolio makes a lot of sense. So it's balanced exposure between SA equities, bonds. We think there's some attractive property stocks, healthy exposure to global equities. I think that's the key message is we're not at a time where you ought to be full of cash, which is where we see a lot of the SA savings industry. And the news in South Africa is not good. Politics isn't good. The economy isn't good. That doesn't mean that you shouldn't own SA equities and bonds because it's about the price those things are trading at. You know, we're not journalists, we're investors, and that's the single biggest distinguishing feature between the two. You know, investors care about price, whereas journalists just care about, you know, the economy. And I think prices are low. So I think my big message to the retail investor is you want healthy exposure to all the major asset classes other than bonds, global bonds, where we're very negative. Many people have that view, been in a bubble as a consequence of that decade of free money. We had negative returns last year. You know, I think you could have many years of very poor returns. Yeah, I think you just want healthy exposure to SA assets and global equities.
Yeah, and I think many people should look at global equities for the right reasons, and not due to political fears. And I think many investors actually, you know, take that decision based on emotion as opposed to valuations. Chepo, you want to add something?
I do. I'd share in a lot of that sentiment. We're quite bullish in terms of the outlook for SA equities. It's difficult to say what it will do in 2022, but in terms of a long-term perspective, we think valuations are reasonable. Not you know, bet the house type valuations, but valuations are reasonable. On the global side, we think there's an incredible amount of opportunities, even within the overall US market, if you're looking to look in different pockets. But in particular, we think some of the South American markets present incredible value right now, and some really exciting companies at pretty discounted levels.
Lelo?
Yeah, you know, the South African market, you know, has had a divergence between commodity companies and non-commodity companies. SA Inc. only started to raise its head last year. And I think if you're going back to cash-rich businesses whose revenues and profits aren't linked to cyclical factors, that may or may not be, but I think will likely be affected by what's going on in global monetary policy. I think there's some really, really wonderful franchises in South African equity, and sadly, you know, these are oligopoly type businesses, because, you know, our industrial policy is terrible anyway here. So we know how to breed and nourish monopolies and oligopolies in South Africa, and those companies have simply run into spaces that entrepreneurs or entrepreneurial businesses could have come into, but haven't had the capital nor the resources to come into them. So I think a domestically focused SA equities portfolio has a lot of legs to run, I think. Globally, I would continue to be greedy about some of the, again, oligopolies in the States. Industrial policy there has fallen apart. The ability to regulate big tech is not meeting bipartisan or meeting with bipartisan agreement. So companies like Alphabet, like Microsoft, like Apple, if you haven't been in them, well, I'm actually interested in seeing if Buffett is going to pick up Google that he hasn't picked up, well, never owned it, has Munger's always talked about it, but those are the sort of businesses that I'd love to, you know, love to go back into. We already hold them anyway, so with new money that comes into our global equity portfolios, we'll be buying more of those.
Interesting. Kanyesile asks, what do you think about commodity stocks, and why are they so cheap, you know, price earnings wise? I don't know.
Well,
Carl?
I mean,
or Delphine?
No, I was just going to say that a PE is both price and earnings, and so the E at the moment is very big, so you're dividing by a very big denominator, and so you should normalize that. That's not a necessarily normalized PE, to answer her. So that optically it looks low, but the E below is very high. So it's peak earnings for many instances. The only comment I'd make before the others take over is simply that, you can't really lump all commodity stocks into one bucket. I think you have really different stories for each one of them. Perhaps the ones that have a better medium term outlook are the ones that benefit from just this massive transition in a global energy space as we move to solar and wind. And so you look at the likes of obviously copper and nickel, and then anything that is involved in batteries, so things like lithium, cobalt, etc. But yeah, so I would just say that the PE is just an optical one, but there's some structural tailwinds to certain of the commodities. You really can't put them all in one bucket. Very different outlooks on supply and demand.
Is there anyone else who want to comment on commodities?
Yeah, I would just say that if you compare this commodity bull market to the one in the early 2000s, finished in June 2008, we were incredibly negative for all commodities at that time and took a lot of pain before it turned. But if you look at our portfolios today, I think it's more nuanced, as Delphine was trying to say, is that while there's some commodity shares that I think are incredibly expensive, like Kumba and BHP Billiton, very big iron ore businesses in them, I think there are many commodity shares that are still really cheap today. And whether it's an Anglo or Glencore or some of the sort of fossil fuel businesses that the market's just put on very, very low multiples, like Exxaro. I think our gold shares are interesting. We haven't owned gold shares for many years. And I think they've become much better businesses and more shareholder friendly, but the market's given up on them. And they look really cheap to me. So I think there's still opportunity, but I think it's, again, you've got to be careful of the broad brushstroke because there are some that look really expensive to us. So after the kind of returns we've seen, I think you've got to be much more careful. You've got to apply much more of a stock picking lens to the issue. But there's still opportunity, I think.
I think
Ramesh, sorry.
So I was just going to add that what's obviously critical at this point in the commodity sector is the capex cycle. Most commodity prices are way above the incentive price, way above the marginal cost of production. And commodity businesses, even when they're earning below the cost of capital, never decide to go out of business. And when they're earning way above the cost of capital as they are now, and the incentive prices way high now, will think about growth opportunities. And I think you've seen in the platinum sector, I tell you, Impala and Northam fighting over RB Plat. And when they get it, they're getting it for more than if they were to dig the shaft themselves. But they don't want to take 15 years to dig a shaft, and who knows what happens with the commodity in 15 years, right? They want to own the shaft now, and they want to be able to produce revenues out of it now. But this is a capex cycle that they all are staring into. So in the past 3 or 4 years, all the revenues, at least most of the revenues, the market thought, well, we're going to get great dividends out of that. Now, companies are indicating to you that they're putting money back into the ground. So the capex cycle is turning, and who knows what's going to be or what's going to come off demand. Maybe demand will hold up, maybe it doesn't, and that's a risk that sometimes you take in high capital intensive businesses.
Rek, if I can just add one more comment to that, I think there's structurally been an underinvestment in the South African industry for the better part of the last 2 decades. And what that's resulted in is some businesses that are willing to acquire either existing mines or greenfield projects that house very quality assets at pretty reasonable prices. So the likes of Afrimat are businesses that we are keeping a close eye on because we think that they are unlocking quite a tremendous amount of value just by virtue of the general underinvestment in the South African mining space.
Damesh asks, global allocation, what are your views on developed market versus emerging markets, both on equities and in bonds? Calder, do you have any strong feelings about emerging markets?
I think emerging market equities are very cheap. I think it's been hell for emerging markets for the last 5 or 6 years. And we find so many very cheap businesses with good prospects. Always the sort of discomfort that comes from the sort of political environment in which they've been forced to run those businesses, but they're great businesses that are extremely cheap and they're done pretty poorly. And whether it's China, whether it's South America, whether it's South Africa, whether it's even a place like Turkey, parts of African markets, these markets have not experienced what you've seen in developed markets, and prices are low and opportunities abound. And I think you want healthy exposure to EM equities.
Just to put it in context, Greg. Yeah, I was just going to say, to put it in context, if you look at kind of the largest, indices that represent world markets, which is typically the All-Country World Index, emerging markets are less than 10%. I think they're 9%. In that index versus developed markets, which are over 90 by implication. And so, and I think to one of the previous callers' questions about, in a global portfolio, what would you allocate? In the US, equally is, over 60%. North America is 60% in the same index. So the point being that it really makes no sense to be at the benchmark weights in emerging markets. You could be easily, our global portfolios are probably close to 4 times, the benchmark weights, simply because of, as Carl said, just unbelievable opportunity. It's a bumpy ride though, and I think a lot of investors are not willing to kind of look out, but your entry points and are rewarding you for the risk, and that's really when you choose to invest. Even a market like Russia has some, unique businesses that can offer you, potentially good compound growth. And obviously, we would look for bigger discounts when we enter. We would look for, much more conservative valuations. But there's a whole cohort of countries, and I guess globally, investors who manage flexible portfolios have been very underweight. So there's been, particularly, even South Africa alone, we've had foreigners selling South African equities probably for the last 7 years. They've been disinvesting. Last year alone, just massive. So you just have this kind of wall of money moving against this theme. And this has just sets you up for potentially very good returns from here, as long as it's, business specific, and you're entering and you do the work.
Just lastly, I think we're going to wrap with this question. It's Jason asks, he says, you've alluded a lot to stock picking as the strategy to follow, but he asks, in which sectors do you actually see the most value? And could you maybe mention the names of 1 or 2 companies one could investigate for, probably offering more value than others? Chepo, let's start with you.
I guess the whole point of stock picking is you are looking across the different sectors and are looking for opportunities within there. I think we just touched on the commodities and resources sector as a whole, and even within there, there's a series of names that are quite appealing, irrespective of price. I think if you had to nail me down to an overall theme, at least domestically, that I think is asserting itself from a price mismatch. I think broadly speaking, the small and mid cap space, which did do well last year, still offering quite a few incredible businesses at attractive prices, and I am being particularly vague in terms of naming particular companies.
I think you've said Afrimat earlier.
I did.
Okay, Carl?
Yeah, I hear that someone wants a sector, but I just think that we just see value everywhere. If I look at the financials and I look at a stock like RMI or Transaction Capital, if I look at some of the banks, if I look in the industrial space, I think there's value in global stocks listed here like Naspers, but then the domestic stocks that like Soho Gaming, you know, recovering from the, you know, absolute hell of COVID, very cheap, high quality growing company like Dischem, resources, I mentioned earlier, Anglo-American, Glencore, Xara. I mean, there's just lots of value. And I wouldn't narrow myself to one sector. It's been hell for the average domestic company and in the market. A lot of these shares are trading 30, 40, 50% below their all-time highs. And yeah, I just think there's lots of opportunity. I don't think you want to narrow your field at all.
Yeah, and over the last few months, or actually last year, we've seen pretty robust earnings, especially in the context of what happened in 2020. The companies seem to be coming through it relatively well, or many of them at least. Shelo, your sectors you are looking at?
Sure. You know, we look at companies like Anheuser-Busch that have taken a hit, self-induced, admittedly, from the acquisition of South Africa breweries, an enormous amount of debt, and in a, you know, really unexciting macro environment in the markets in which they operate, especially Brazil and South Africa and the rest of the continent, Eastern Europe. But the deleveraging opportunity in Anheuser-Busch and the prospect of reinstating a dividend again at a high rate. British American Tobacco, that's also had a self-induced problem with its acquisition of Reynolds, is working through that and toggling towards next generation cigarettes. Still some regulatory risk, but they're getting on top of that. You know, we think NASPA's on process, again, self-induced problems with governance, but the fact that the share prices took a hit relative to the intrinsic value below that, if you consider the fact that Process, which owns about 29% of Tencent, and Tencent has about $185 billion worth of you know, investments on its balance sheet, including Tesla, which they're going to unwind at whatever pace. Process gets 29% of that is about, you know, $58 billion possibly. You know, not to mention what could become of the underlying businesses in 5 years or less, I guess. Those are great opportunities for us. I mentioned banks earlier, banks that are coming back from being not so great banks like ABSA to being better banks. Obviously, FirstRand is a high quality business, trades more expensively than the other banks. But from an endowment capital standpoint, endowment benefit, when rates rise, someone like Nedbank and Absa, Eastern Bank benefit more than any other bank. And then, of course, you have a whole slew of our smaller firms. I think Carl mentioned Dischem, not cheap by any means at all, but my God, is it really, you know, leading the way in terms of new areas of providing healthcare to the consumer. So we really like domestics with some smattering of dual listeds, so to speak.
Delphine, last word to you.
Yeah, I think it's interesting. The whole point about, you know, which sectors are in vogue and not in vogue. Interestingly, people like to look for a theme because there tends to be a rhyme within a sector, you know, resources, you know, whether it's food, retail, banks, etc. But ultimately, this is a winner-loser, you know, game. So even as you drill down within sectors, there's always going to be a range of performers. So that's really what we like to do. And with unsurprisingly, all of us are looking at the same information, and if we all have similar investment horizons, you shouldn't be surprised that we're going to have, you know, surfacing similar ideas. So you know, some commonality in some of the stories that have been presented so far, like BTI, Anheuser, and the NASPA's process for the first time in a long time, perhaps looking very interesting to us, you know, really coming into almost value territory, trading at some of the widest discounts we've seen it at, but perhaps some different ideas that have not been mentioned that are in our portfolios. So I mentioned the hospital company, so Life Healthcare and Netcare, we think attractively priced. And then in this kind of restructuring space, stocks like Massmart, Oceana has lagged quite a lot. We like, and also Datatech had a stupendous year last year, but we still think the stocks very undervalued, particularly given it's in the middle of a corporate restructuring. So there'll be quite a lot of value unlock coming there. And then perhaps a final one that perhaps has been, a real laggard over the last decade, and that's in construction and Wilson Bailey's, worth having a look at.
Well, that's all we have time for. Thank you so much to the participants, Delphine Govender from Perpetua, Shlelo Giose from First Avenue, Carl Leinberger from Coronation, and Chepo Modiba from Canon Asset Management. Thank you so much for your participation. I thought this was an excellent discussion, and it did reveal a lot of divergent views, but in many ways you can try and put the puzzle together of where markets are going. But the general impression I get is that you are positive, and yes, there's a lot of noise in the market, but there are definitely opportunities. Thank you so much for your participation and insights today. A recording of this webinar will be available a bit later on the Moneyweb website, and we will send a link to each participant and listener shortly after it becomes available. So have a look out for that. And that's it from me. Thank you for tuning in to this webinar, and hopefully 2022 is an excellent investment year for you. Have a good day.